As the U.S. markets are currently closed, Oracle Corporation, trading under the ticker symbol ORCL, ended its last session on Tuesday, October 7, 2025, at a price of $284.24. This represented a significant intraday drop of $7.35, marking a 2.52% decline for the day. Now, on the surface, a 2.5% dip on a legacy tech giant might seem like standard market volatility, perhaps a reaction to some analyst downgrade or a slight miss on a minor metric. The common expectation is to brush it off as noise. But the reality of what's happening under the hood of Oracle stock is far more complex and points to a critical narrative shift that most retail investors are missing. That 2.52% slide isn't just a random fluctuation, it's a symptom of a much deeper institutional reevaluation of Oracle's place in the new hierarchy of technology. We're seeing a quiet but deliberate reallocation of capital, and the data from yesterday's trading session reveals footprints that suggest a growing skepticism about the company's forward-looking growth trajectory, even as the prevailing belief is that Oracle is a safe, dividend-paying stalwart. This isn't about one bad day. It's about whether the foundation of the bull case for Oracle is beginning to show cracks. The general consensus, the story many investors tell themselves, is that Oracle is an unassailable fortress. It has a massive, entrenched customer base locked into its ecosystem of databases and enterprise resource planning software. It generates prodigious amounts of cash flow, buys back its own stock, and offers a respectable dividend. For someone managing their portfolio through a service like Schwab Intelligent Portfolios, or building a long-term position in their Fidelity brokerage account, Oracle has long been presented as a cornerstone holding. Less volatile than a high flyer like Nvidia stock, but more robust than a speculative play. The expectation is one of stability and predictable, albeit modest, growth. The company's multi-billion-dollar acquisition of Cerner was supposed to cement its position in the healthcare technology sector, opening up a new frontier for expansion. This is the comfortable narrative. But the challenging reality is that this perceived stability might actually be a form of inertia. In the cutthroat world of cloud computing, where Amazon's AWS, Microsoft's Azure, and Google Cloud are innovating at a breakneck pace, Oracle's cloud infrastructure, OCI, is still fighting for a larger piece of the pie. The 2.52% drop yesterday was accompanied by trading volume that was roughly 15% higher than its 30-day average. A deeper inspection of the block trades, the large institutional orders executed through platforms like Interactive Brokers, shows a clear pattern of distribution, not accumulation. It suggests that some of the big money is quietly reducing its exposure, not in a panic, but in a methodical, calculated way. While individual investors using the Robinhood app might have seen the dip as a buying opportunity, the larger, more informed players were using the liquidity to lighten their positions. This divergence between retail sentiment and institutional action is a classic red flag. The market is beginning to question if Oracle's legacy business can continue to fund its cloud ambitions effectively enough to compete with rivals who have a significant head start and arguably a more innovative culture. Let's dissect that recent price action further. The selling pressure was consistent throughout the trading day, indicating it wasn't a knee-jerk reaction to a single piece of news. It was a sustained offloading of shares. This kind of movement often precedes a more significant re-rating of a stock. We also saw a notable increase in bearish options activity. The put-to-call ratio spiked, suggesting that more traders are buying contracts that pay off if the stock price falls further. This is the financial market's way of hedging bets or outright speculating on a continued downturn. This is a far cry from the sentiment surrounding a name like Apple stock, which, despite its own challenges, continues to command a premium due to its ecosystem's perceived strength. The macroeconomic environment is also playing a critical role here. With interest rates remaining elevated, the market is less forgiving of companies that cannot demonstrate a clear path to accelerated earnings growth. Capital is becoming more selective. A company like Oracle, which is projecting single-digit revenue growth, becomes a less attractive place to park cash when compared to other opportunities. Investors using platforms like SoFi Invest to build their portfolios are increasingly being advised to focus on companies with clear, demonstrable catalysts for expansion. And Oracle's primary catalyst, the growth of OCI and the successful integration of Cerner, is still a subject of intense debate among analysts. For those less familiar with the company's core operations, Oracle is fundamentally a software and services behemoth. Its reputation was built on its dominant database technology, which for decades has been the backbone for countless corporations worldwide. From there, it expanded into enterprise software, offering suites of tools that manage everything from financials and supply chains to human resources. This is its cash cow business, the legacy segment that provides the financial firepower for its newer ventures. The most significant of these ventures is its push into cloud computing with Oracle Cloud Infrastructure. OCI is designed to compete directly with the hyperscalers, offering computing power, storage, and networking services over the internet. While it has gained some traction, particularly with its existing enterprise customers who are looking to move their Oracle workloads to the cloud, it remains a distant fourth in the market share. The company's business model revolves around long-term contracts, licensing fees, and recurring subscription revenue from its cloud services. Its past performance has been characterized by steady, predictable earnings, which is why it became a favorite of value and income-oriented investors. However, the market is a forward-looking mechanism. It cares less about the billions Oracle earned last year and more about the billions it will earn in the years to come. The acquisition of Cerner, a massive player in electronic health records, was a bold move to create a new pillar of growth. The idea is to modernize healthcare data management and leverage Oracle's cloud and AI capabilities to improve patient outcomes and operational efficiency. The potential is enormous, but so are the challenges of integrating such a massive and complex organization. Looking ahead, the future outlook for Oracle is balanced on a knife's edge, creating a fascinating tension for anyone holding the stock in a Fidelity IRA or considering initiating a position. There are two very distinct paths the stock could take. The bullish scenario hinges on the successful execution of its cloud and healthcare strategy. If Oracle can demonstrate that OCI is gaining market share not just by migrating existing customers, but by winning new cloud-native clients, it would force a major reevaluation by Wall Street. Success here would mean proving its technology is on par with or superior to the competition in key areas like price performance. Furthermore, if the Cerner integration proceeds smoothly and Oracle can begin to show meaningful revenue synergies by upselling its broader portfolio of products to this vast new healthcare customer base, the growth narrative would be validated. This could push the stock significantly higher, rewarding those who bought in during periods of skepticism. In this scenario, the recent 2.52% drop would be seen in hindsight as nothing more than a minor blip. With the Cerner acquisition still being digested, what's your take? Comment below whether you think Oracle's big healthcare bet will pay off in the next 5 years. Conversely, the bearish scenario is just as plausible, and is what the recent institutional selling seems to be pricing in. In this version of the future, OCI's growth stalls. It fails to make significant inroads against the deeply entrenched competition, and its growth rate decelerates, disappointing the market. The Cerner integration could prove more difficult and costly than anticipated, leading to write-downs and a drain on resources without delivering the promised revenue growth. In this case, Oracle would be perceived as a legacy company in a state of managed decline, its legacy cash flows masking a fundamental lack of innovation and an inability to compete in the most important technology markets of the future. The stock would likely stagnate or drift lower, becoming a value trap that ties up capital that could be better deployed in more dynamic companies. This is a significant concern for any investor, whether they are engaged in self-investing or utilizing investment help from a professional. The decision to invest in a company like Oracle through an individual brokerage account now involves a much more nuanced calculation of risk versus reward than it did just a few years ago. In summary, the story of Oracle is no longer a simple one of stable, predictable enterprise software. The expectation of a safe, cash-gushing behemoth is colliding with the reality of a company in the middle of a high-stakes, multi-front war for its future. That 2.52% decline is a data point, but it's also a reflection of this central conflict. It represents the market's growing impatience and its demand for proof that Oracle's massive investments in cloud